Hey everyone, hope you all are doing well. Did you know that investors who recently participated in Tata Technologies IPO made 140% listing gains?
What time is it?
It's IPO time, baby!
The issue price of the IPO was 500 rupees and the stock got listed on the exchange at 1200 rupees, thereby making Tata Technologies IPO one of the best listings in the last 2 years. On the other hand, investors who participated in Paytm's IPO in November of 2021 lost 27% of their capital on the very first day of listing. The price band of the IPO was Rs 2080 to 2150, and on the day of recording this video, Paytm is trading at 690 rupees. Till date, investors are sitting with 69% of their capital eroded in this share.
That's why I didn't want you to invest.
It is clear that making money by investing in an IPO is easier said than done. So in today's video, I am going to share with you what is an IPO, which document gives you the most credible information about the target company, and what important aspects should you look at in order to properly analyze an IPO and make an informed and sound investment decision. In case you are new here, then do smash that subscribe button, because I've heard that 99% of my subscribers find money in their pockets they didn't know they had.
Check your pockets!
I just found baby carrots in my pocket.
So without any further ado, let's get started. What is an IPO? An IPO, or initial public offering, is basically a process wherein a private firm offers its shares to the public for the very first time in order to become publicly traded. To simplify further, it's like a debut of a company in the stock market. An IPO allows retail investors like you and me to join the growth journey of a company in its early stage of being publicly traded. The objective of investing in an IPO can be to catch the listing gains or to build wealth in the long term. Investors who are confident in the fundamentals of the company and its future growth prospects will be the ones who invest in the IPO for a longer tenure. Now, IPOs tend to get a lot of media coverage and they spur excitement and buzz in the market. But just because there is a hype towards a particular IPO, it does not necessarily translate into being a worthwhile investment opportunity. The thing is, when a company comes up with an IPO, then a large part of your investment decision should be driven by the information that you garner about the company and not the media coverage.
Can't believe everything. You know how the media likes to spin stuff.
You need to be aware about where to get the most credible information about the target company. One document that gives you a plethora of authentic information about the company is the red herring prospectus. The RHP is a preliminary registration document that the company files with SEBI when it proposes to come out with an IPO. You can easily find this document on SEBI's website by going through the trail shown on your screen. Alternately, you can also click on the link that I've mentioned in the description of this video. Now that you know where to get credible information about an IPO company, let me share with you 9 key aspects that you must research on in order to get an in-depth understanding of the target company and its future growth prospects. This research will aid you in raising red flags and consequently give you a strong conviction that is required to invest in an IPO. So the first thing that you must look at is the business model of the company. A very convenient way would be to use Alex Osterwalder's business model canvas, which is really helpful to create new business models and even documenting existing business models.
What you making?
Video from my dog bed company.
It's a crappy business model.
As you can see on your screen, a business model canvas contains several quadrants which helps you to understand different facets of a business. I will go through them one by one so you can easily document the business model of the IPO company. So first off, on the right corner is the customer segment quadrant, which involves knowing who are the paying customers of the business and what are their pain points. Then comes the value proposition quadrant, which consists of the bundle of products and services that the business offers to each customer segment. Now, no business can sustain for long term if they have a poor relationship with the customers. And so there's a separate quadrant that focuses on what type of relationship the business has with its customers, how much support does the business provide to them, and lastly, how are new customers acquired and retained. After that comes the channels quadrant, which consists of the touch points that the business uses in order to interact with its customers. It basically involves looking at the supply chain, the distribution network, and the marketing initiatives made by the company. Moving on, every company requires a certain infrastructure to create, deliver, and capture value. This detail is covered under the key resources quadrant, which consists of the indispensable assets without which the company cannot operate. Just above the key resources quadrant is the key activities quadrant, which consists of knowing which things the company really needs to focus on in order to perform in the most optimum way. For a manufacturing firm, it can be the production process. For a consulting firm, it can be the consulting methodology. And for an e-commerce trading company, it can be an expertise in supply chain management. Now, what is the main objective of a company? It is to drive in sales, bring in profits, and make the shareholders of the company wealthy. This part is covered under the revenue streams quadrant, which involves knowing how a company generates revenue, what are the channels through which customers make payment, and lastly, what is the pricing strategy of the company to be relevant in a competitive landscape.
This is an untapped market where you dictate the competition.
Now, where there is revenue, there are also going to be certain costs involved. Adjacent to the revenue streams quadrant is the cost structure quadrant, which consists of the key costs that the company has and their nature being fixed or variable. Additionally, it also includes assessing the capacity utilization of resources in order to gauge whether a company is benefiting from economies of scale. The last quadrant is the key partnerships quadrant, which consists of the key partners of the company and the motivation behind being associated with them. For instance, a key partner can be a supplier of the company who provides key resources without which the company's production could be halted. Once you understand the business model of the company, the next aspect that you must look at is the financial performance of the company. You should start by analyzing the financial statements, which include the balance sheet, the profit and loss statement, and the cash flow statement. Analyzing them will help you gauge important financial parameters such as year-on-year revenue growth, EBITDA margin, PAT margin, debt to equity split, operating cash flows, and much more. If a company has a robust financial position with high sales and profit CAGR, then it is indicative of a sustainable growth in the future as well.
This is big, sustainable growth over the long term.
Post looking at the financials of the company, you should also ensure that you have subscribed to my channel for awesome content on personal finance.
What?
Oh, sorry. Post looking at the financials of the company, it is paramount that you get an even wider view by doing industry and economy analysis. It will help you to gauge the overall attractiveness of the industry and decipher for yourself whether the market conditions are in favor for the upcoming IPO. Under industry analysis, you should take a look at the competitive dynamics within the industry, the growth rate of the industry in CAGR terms, the market share of the target company in comparison to its peers, and the different customer segments that bring in revenue for the company. You can get this information from industry reports published by Big Fours, commercial banks, and top consulting firms. When it comes to economy analysis, you should see how both the global and the domestic economy are faring. Things like high inflation in the US, increased interest rates, and trade wars can have a negative toll on companies whose major revenue comes from exports. Likewise, domestic economy factors such as government policies, political stability, GDP growth rate, and the capital market conditions also have a major role to play in the success of an IPO. Once you are done with industry and economy analysis, the fourth aspect that you must focus on is the moat of the company. Moat is basically a company's long-term sustainable competitive advantage that safeguards its profits from competitors and external threats.
What are you looking for?
A competitive advantage.
To give you a few examples, moat can be granted patents, secret recipes, a robust distribution network, superior technology expertise, a brand name that has a strong recall value, or even the existence of a management team that has a history of building multiple successful businesses.
Our management team is robust.
Also, it becomes easier for a company to raise funds for future expansions as well, because investors typically prefer companies with durable moats. Now, the next aspect that you must look at is the use of IPO proceeds. For this, let's first understand the difference between a fresh issue and offer for sale. Fresh issue is when a company allows new investors to take part in the ownership of the company. Here, the existing investors do not sell their stake in the IPO, and the money raised is received by the company for its growth. The drawback is that there is dilution of ownership for existing shareholders. On the contrary, offer for sale is when the existing promoter or investors sell their stake in the company. Here, the money goes to the promoter or the investor selling his stake. The advantage here is that there is no equity dilution, but the disadvantage is that the company does not receive any proceeds from the IPO. Now that you understand the difference between the two, it is important for you to know whether the company is doing a fresh issue or offer for sale. In case the IPO is an offer for sale, then it is important for you to find out the reasons as to why the existing investors or the promoter is selling his or her stake.
His business is doing well. Then why is he selling us for a dime?
On the other hand, if there is a fresh issue by the company, then you should look out for two things. First will be the interest from institutional investors, and the second thing will be that how the company will use the money raised from the IPO. If pension funds, commercial banks or mutual funds show interest in an IPO, then it is a strong indicator of potential success of the company. In regards to the use of the money raised, if it is used for debt repayment and the company's debt to equity is quite high, then it can be a red flag.
He tried to raise money all day.
But why?
He's paying for everyone's debts.
On the contrary, if the proceeds are used for a new product launch, geographical expansion, or for that matters, R&D purposes, then the IPO can be a viable investment for the long term. The next aspect that you should focus on is the valuation of the company. Let me share with you some widely used methods to value a company. First, there is the comparative analysis where you compare the IPO company with similar companies that are already listed. Then there is the discounted cash flow analysis where you estimate the present value of the company's future cash flows. And another popular way is the earnings multiplier method where you use the P ratio to analyze if a company is fairly valued, undervalued or overvalued.
They're selling the company.
At what price?
On a $60 million valuation.
Now there is one drawback when you value a company through these methods. They do not factor in the effect of investor sentiment in the capital markets. Sometimes the buzz created by media is so much that investors get overexcited and the IPO gets oversubscribed. It doesn't stop there. Due to the oversubscription, a lot of people to whom the shares are not allotted, they buy the shares on the listing date, which leads to the stock price of the company to get even more inflated. But it's good for the short term, meaning people who are interested in listing gains can benefit from it. But then after few weeks of listing, the markets play the game of demand and supply, and the price of the target company ultimately corrects to reach a fair market value. Now, no business can run without risks, and so the next aspect that you must look at are the risk factors involved. This would involve ensuring that the regulatory environment of the industry is favorable for companies' sustainable growth. For example, the tariffs and international trade policies, tax reforms and changes in minimum wage laws can pose a serious threat to a company's top line as well as bottom line.
So what kind of research are you doing?
Tax reform, trade agreements.
Other risks that investors need to check upon are pending legal cases, contingent liabilities, and employee turnover at all hierarchical levels. Typically, companies that have business continuity and risk mitigation plans set up in advance are in a much better position to deal with business uncertainties. Now, if you are investing in an IPO for medium term, then your analysis doesn't stop pre-IPO. After the shares of the company are listed, you also need to pay attention to the lockup period expiry. For those of you who don't know what lockup period is, it is the period after the IPO listing date, usually 90 to 180 days, during which the insiders of the company are restricted from selling their shares in the market. It is important to watch the stance of promoters, companies' employees, and early investors post the lockup period expiry. The reason is that if these insiders decide to sell a major portion of their shares, then it can be perceived by the market as a lack of confidence in the company's future growth prospects. It can thereafter result to a major correction in the stock price of the company, thereby eroding the wealth of the retail investors. Last but not the least, the ninth aspect that you must focus upon is the IPO details. This would include looking at the opening and closing date, the price band at which the shares are issued in the IPO, and the lot size that represents the minimum number of shares you need to buy. You must also check the issue size, which tells you about how much money the company is raising through the IPO.
What you want to know? How much have you raised?
Once you apply to an IPO through a stockbroker, the shares are then allotted to you on the allotment date, and on the listing date, the shares of the IPO company are available to be traded in the stock market. So there it is. These were the 9 key aspects that you must research on before making a decision to invest in an IPO. The in-depth research will give you clarity on the fundamentals of the company and help you in navigating your money towards the right IPO. Remember to always look beyond the hype and media coverage and refer to the red herring prospectus for the most credible information. Hope this video was able to give you valuable insights on how to analyze an IPO. Thank you so much for watching. Like, share and subscribe, and stay tuned for my next video.